And the last thing for new features that I wanted to talk about, new tools, was the Attribution Visualizer. And I think that there's a really fun example that just happened in the market, which demonstrates what's going on here. But if it's been in Coinbase has been in the news, and it got added to the S&P, and then there's this genius bill that kind of came out that's been bullish for coin. But you can actually see here what we did in this tool is you put in your ticker, you put in the strike. This assumes that you bought the option and that you just hedged it every day at the close. And you put in the expiration date and the strike and the option type, call or put, although it does not actually matter really if you put call or put, because remember, it's going to be a delta hedged position. But you put in the trade, and then what happens is it just says, based upon every day's close, what would my P&L have been? That's the actual. This is with the actual P&L is just very easily calculated. It's just, hey, you can see you put the trade on at when coin was 260, just about $264. And I'm saying, hey, you bought the 240 call and you would have sold 74.70. It's a 74 delta roughly at that time. So you buy one call, you sell 0.74 shares, and you're delta neutral. What happens? The next day, the stock drops by $2.38. So what happens? Well, you were long call and you were short shares. So your call premium fell. So you lost $2.73 on your call that you were long, but your shares made $1.75 because the stock dropped 238 and you were short 0.73 shares. So here you lost a dollar, right? You made $1.75 on your share P&L and you lost 273 on your options coming in. So and you can see that the implied vol of those options had fell 63.5 to 61.1. So you start with what actually happened? Well, I actually lost a dollar. Like, where did the dollar come? Where did I lose that dollar? How did I lose a dollar? Well, I can see that the vol came in by 2.4 vols. 60 cents of that dollar is explained by my Vega P&L, by the fact that the vol came in 2 points. That's my Vega P&L. And then I had a realized P&L because I made money on my gamma, presumably, right? Because I sold shares at 263.87. And then the next day, I was able to buy a little bit of stock because the delta of those calls fell a little bit, right? As we got closer to the strike, lightly. So I got to make money because I sold stock at 263.87 and I bought some stock back at 261.49. So I made some, that's my gamma P&L. My gamma P&L was tiny. I only made 2 cents because it was a very small move. My delta didn't change much. So I made 2 cents. I lost 27 cents in Theta. So what happened is my realized vol P&L, which is my gamma P&L plus my Theta P&L, I lost a quarter. So we can see here that I lost 60 cents on the Vega. I lost another quarter on the realized P&L. So I lost 85 cents. So 85 cents of that $1 of loss is accountable to realized P&L plus Vega P&L. And then I end up, there's a little bit of an interest P&L thing there that I won't go into. It's because it's a small percentage of your P&L per day, but I won't go into that. But what's left over is what we call the unexplained. So you can think of it as, hey, my actual P&L was I lost a dollar. 85 cents of that P&L was explained by my Greeks, by the realized P&L and my Vega P&L. And then there's 15 cents of like residual noise. And the residual comes from the fact that when we compute a Vega P&L and we compute a gamma P&L, your gamma and your Vega are not constant over the entire length of the move. So we're making a prediction based upon what your Vega was as of yesterday's close, but your Vega changed throughout the day. So there should be like a gamma of Vega component in there that's like a higher order Greek that you could make the attribution to. And if you were to like do the whole Taylor expansion, you would get closer to that dollar, being able to explain everything of that dollar. I personally think that's super overkill. That's how we do attribution. I lost a dollar, 85 cents of it is coming from Greeks. Here, what you find, so that's kind of like explaining day over day how we're computing your P&L as it attributes to Greeks. If you track this every day, you just do that process over and over for every day, and you just say, I'm going to hedge every day at the close. what you will have found is that you've been losing money on owning, this is always from the perspective of a buyer. You have been losing money owning this call and hedging it every day. You've been losing pretty much for the last month. And you can go over here and you can see your actual P&L is the real P&L, and then the other stuff is really the attribution. And you can see as your worst P&L, your worst cumulative, right around June 13th, you're down $6 on a delta hedged basis. Remember, like these calls, they were about $34 when you put them on. You've been hedging them every day, and the sum of all your share P&L and option P&Ls for over this like almost a month is that you've lost $6 on these things. And then we start to get the volatility recently. And then you get the giant 16% rally yesterday. And you can see your actual P&L is you are now up almost $5. I mean, you're just bleeding. And then in one day, you make almost $5 back. So that your cumulative P&L now is almost $2, positive $2, instead of being down $6. So, or down $6 a couple days ago. You've been making, you made money. You had two really nice days, so you had this jump up in P&L on the 16th. You made almost $4. Lost a little bit after that, and then on yesterday you made almost $5, which basically you made all your losses back and then some in 3 days. So this is what I wanted to point out was here actual P&L is much your actual P&L is 473. I actually think this is like pretty instructive to understand the unexplained P&L that I was talking about a little bit better. Again, we start with what actually happened. What was my share P&L on that day, and what was my option P&L, right? Really basic accounting that you would see it in your Interactive Brokers account. This is my share P&L and option P&L. I made $4.73. I would have predicted that I would have made $15 based on the fact that when the stock was at 253, I was long a bunch of gamma. I mean, I was long gamma, and the stock had a really big move. Remember, your gamma P&L is kind of a neat trick. If you wanted to compute your gamma P&L, you would just take the stock price squared times the return of that day squared and just multiply that by your gamma. And that's actually your gamma P&L. So if you imagine a $100 stock that moves 2%, well, 100 squared is 10,000 and 2% squared is 0.0004. So 0.004 times 10,000 is 4. And if you had 1,000 gamma, your gamma P&L would be $4,000. That's what your predicted gamma P&L. What happened is you should have had this giant gamma P&L based upon the fact that we were at based on our prediction, our gamma P&L, because we moved 16%. So what you're taking is the stock price squared times 16% squared. And this is why gamma is why your P&L to options is nonlinear. You're squaring these returns when you're multiplying by the stock. On a 16% move in Coinbase, you should make a giant amount of money. But we did not make quite as much money as we thought, because as you got further from the strike, remember at some point the stock was at 253, but by the time the stock is at 270, 275, like your gamma is just totally disappearing, right? The stock is becoming almost 100 delta call. So our gamma prediction, our P&L prediction from the gamma is an over prediction because it assumes that your gamma was constant over the whole move, and that's not true. So what happens is that over prediction, the difference between the over prediction and how much you actually made becomes unexplained P&L, and that unexplained P&L, we can see it says negative $10, which is basically saying your actual P&L underperformed your predicted P&L by $10. And that underperformance is due to the fact that your gamma was not constant over the whole size of the move. So this tool really answers the question of like, is the vol trade aspect of what I'm doing correct? By the way, this total unhedged P&L. This assumes you didn't hedge at all. So we just put it in there. If like you just bought for May 19th, if you just bought the call for $33.88, you made $19.60 as of yesterday, because the calls are now worth $53.48. So this is just like simple, what's my P&L? But your delta hedged P&L that's like the final P&L. That's the thing you really want to look at. That's your actual P&L. And the rest of this stuff is really about attribution, but your actual P&L is what you care about. And this tells you that I pick a good vol trade. So that's kind of a useful tool. I think one thing maybe I'll do it on another video because I don't want to bog this down. But like one thing that's really interesting here would be to say, you notice that the stock is at, the stock is at 293. What's interesting would be like, hey, when the stock was back at 264, and if you bought the put, the 250 put, and sold the 300 call, or vice versa. Basically, you did the delta neutral risk reversal. If you basically pulled this thing up twice and took the P&L from each leg and summed them together, one is like buying, one is selling, you would actually see that would be the same, that would simulate what if I did the risk reversal delta hedged every day. So I bought the risk reversal. So I bought put, sold call, and I bought the stock, and I just hedged the risk reversal every day. And that would actually tell you, how did I do on the hedged structure? So you just do one leg at a time, and that's exactly what you're getting here without us, we didn't build a UI to be like able to put in a whole bunch of options in here and then simulate that. But that's how you could do it yourself if you wanted to. Okay, that's all right. That is basically it on the new features.